Looks like it may be back to the future for BlackRock. At least that's what you're talking about today, Jeff. You've been looking at BlackRock and whether it needs to maybe jump into private equity, which is where it first sprung from.
Yeah,
in the 80s.
So BlackRock reported last week net income of $2.9 billion on assets of $4.3 trillion. And Blackstone, the private equity firm, is getting ready to report its results next week. And if the analysts are right, they're going to have the exact same net income of $2.9 billion,
and yet
on $250 billion of assets.
So they're far smaller.
Yeah. So
and yet doing just as well.
Yeah. So I mean, it gets you thinking. I mean, obviously they're very different businesses, but at the same time, BlackRock, sprung out of Blackstone. It originally was sort of a small business that started there 25 years ago. They were sold, separated. And now they're the biggest money manager in the world.
Right.
Credit to Larry Fink there. The question, though, is, should they be getting into these more lucrative fee-earning businesses like private equity, which clearly, based on the numbers, tells you a lot about what the discrepancies are.
Of course, it doesn't give you quite as good a multiple if you look at where the two are trading, or at least where alternative asset managers, they're trading around 10, 11 times.
Yeah, and look, I mean, BlackRock, they tried to build a private equity business. They've already kind of thought about this a little bit. They tried to build one starting in 2011. They recruited over a team from Merrill. It just didn't work. The market wasn't interested in another private equity fund. The question is whether they could buy one now. Now, I don't think they could buy their, it would be very poetic if they could go back and buy
Wouldn't
Blackstone.
Wouldn't it just, you parents brought us up and now we're here to take you over?
Unlikely to happen. Financially feasible. BlackRock's worth about $55–60 billion in market value. Blackstone closer to 20, but pretty unlikely. What I think is more likely to happen is you have these private equity firms that sort of missed the wave of firms going public and tapping the public markets. TPG, Hellman and Friedman, Providence Equity, maybe Bain to a certain extent.
And all these companies have one big issue, of course, which is their senior partners.
Senior partners
as a result
who are
of doing an IPO.
They've seen how you can liquidate, but the public markets may be out of reach at this stage. We don't know. So maybe BlackRock could come along and buy one of them. And it would solve a lot of problems on the sell side and on the buy side. And as you mentioned earlier, the multiples are pretty compelling too, because BlackRock trades at about 17 times because the fees they generate are pretty steady. The market likes them. Private equity, because it's lumpier, it's based on how they can harvest their businesses. Blackstone, Carlyle, those guys trade around 11 times. So there's scope for them to pay for it. And if the market's willing to then shift a little bit, those earnings would be worth so much more to BlackRock.
No, exactly. And as I think you point out in the piece, it's not as if BlackRock, being so big now, has the ability to grow organically in any way, shape, or form.
When you're $4 trillion, I mean, they're looking at growing 4 to 5% in terms of money that they're managing. Blackstone is still growing 20–25%. You also have this issue where Blackstone and the other traditional private equity firms are now just starting to go after retail investors. And that's going to start cutting into BlackRock's fundraising. So, I mean, there's a lot of interesting dynamics.
A lot of good reasons for them to get into this. Great. Thanks, Jeff. And we'll be back with more breaking views tomorrow.